Hey, your insurance for your home may not be where you need it to be. And that's because in the last several years, home values and construction costs have been on the rise. And so, with that in mind, we brought in local home insurance expert Eric Fox with Fox Insurance and Investments to talk to us about that. Eric, thank you for joining us today. How are you, sir?
Doing well, Mike. Thank you for having me. And I'm glad to offer any insight that I can to those out there who are listening. And I certainly appreciate it.
Well, hey, that's why we brought you on. And as you know, Eric, as I stated, home values have been on the rise for quite some time. And especially in the last couple of years, we've seen values increase by double digits each year. Home construction costs have been rising because the material costs have been rising. So just want to make sure that people are thinking about what they need to be thinking about when it comes to homeowners insurance coverage. So what do people need to be thinking about there when it comes to that?
Certainly. Well, the first thing to keep in mind when you're looking at your homeowner's insurance is that insurance policies are generally written on a replacement cost basis. And I know the first thing people automatically think of is, what's my house worth? What could I sell it for? What did I buy it for? And frankly, that is a very different value than what insurance looks at, which is what would it take to rebuild your home as new construction, labor and materials costs. Whereas the appraisal value or the market value of your home also includes additional things that are not included in what that insurance value would be, such as the value of the land that it sits on. Because if the house burned to the ground, the land is still there. There's still value there. The desirability of your location. If you have a desirable location, that's taken into account with the property or the appraisal value, but not necessarily relevant when you're looking at insurance. So just to be clear to begin with, that when you look at the coverage on your policy, what you're looking at is labor and materials costs to rebuild the structure itself as new construction under current labor and materials prices. Now, most companies will have a reconstruction cost estimate tool. So if you reached out to your agency or the company that you're insured with and said, hey, I just want to double check and make sure you have my reconstruction cost estimate tool correct, that's generally what determines that insurable value, if you will, that's on your policy. And a lot of policies have some automatic adjustment for inflation, which is usually a couple of % each year. But in an environment like we're in, where inflation far exceeds that, then it might be good just to check with the company to make sure they've updated that reconstruction cost estimate for your particular house. Typically, companies will replace the home up to the limit of coverage on the policy. So you want to make sure that you're not making that limit or that ceiling too low to rebuild your home. Many companies will also give you kind of an additional buffer over and above that, anywhere from 10 to 25% above your insurance amount, just in case at the time of loss, the cost to rebuild ends up exceeding what they've estimated. They'll build in that little buffer. And then there are companies out there, there's only a few of them, but there are companies that actually offer guaranteed replacement, which means you essentially have no limit of coverage on your home. And your house will be rebuilt regardless of how much it might cost to do so. And so you can check with your company to see if they offer guaranteed replacement or what that additional buffer would be if they do extended replacement.
Yeah. So Eric, just to kind of simplify it for myself, what you talked about, that replacement coverage, let's say you have a coverage that you've had for a number of years at 200,000, but we've seen this uptick in home values, construction costs, that labor cost has gone up. You might have a gap there where if something happens with your home, you may have a gap in coverage that wouldn't be covered. Is that fair?
That would be fair, because although people will think, oh, my policy is replacement cost, and most policies are. Most homeowners policies replace your home, but it is replacement cost up to whatever limit of coverage is on the policy. and it's really that there's a mutual responsibility to make sure that that number is sufficient. It doesn't fall completely on the insurance company to make sure that number is high enough, but it's, I mean, ultimately it's your policy. So you would want to check your declarations page, and if you've upgraded your home, or if you just feel like that initial number, if you got that policy 10 years ago, and if you feel like that number hasn't kept up with the cost to rebuild, then I mean, either way, it's good to reach out and touch base with your agency, just to make sure that everybody kind of revisits that, and it might be appropriate to adjust that number in the current environment.
Yeah, and that's why I wanted to have you on today, just to build that awareness that we've had these changes. Good to reach out to an insurance expert like yourself or whoever their current agent is, and have that conversation at a minimum. Eric, what we're talking about essentially is a claim. If you have a claim, you have some kind of damage to your property, people are going to file a claim. There's two different methods to settle those claims, and one is actual cash value, one is the replacement cost coverage, which we talked about. Can you talk about the differences there and where people might see that actual cash value method?
Sure. Actual cash value essentially means that depreciation is also going to be factored in to a loss settlement or to a claim. You typically have a deductible of some type that goes along with that. But if a claim is settled on a replacement cost basis, then the insurance company is going to determine how much is it going to cost to completely do this, over again, brand new, or to fix or repair with new. And then they will subtract the deductible, and that's the settlement. With an actual cash value settlement, it's going to matter how old whatever it was damaged is as well, because that depreciation is also going to be subtracted. And where this especially comes into play is there are several companies out there that have started to go to actual cash value settlement for roof claims. Roof claims specifically, even if your policy in general is a replacement cost policy, be wary of if the company has said actual cash value roof settlement. Because if your roof is 10 years old, when you have that roof claim, then they're going to start with the cost of a new roof. They're going to depreciate that value by 10 years. Then they're going to subtract your deductible on top of that. So what you would receive for a roof claim under an actual cash value settlement could be significantly less than what a replacement cost roof settlement would be, depending on the age of your roof.
Yeah. So Eric, does the client usually get a choice when they're purchasing the policy, or is that settlement method determined by the agency?
There are some companies that just do replacement cost, period. There is no choice, because the companies don't even have an actual cash value settlement option for roofs. They're just saying, here's our policy. We do replacement cost 100% across the board. Mm-hmm. So they could have a company where replacement cost just is what they have. There are other companies that do not give you a replacement cost option. They say, okay, part of our policy is that we will give you actual cash value coverage on your roof. So that's just, if you choose to go with that type of a company, that's what you're going to get. Mm-hmm. And then there are companies in between that do give you a choice. Their default option might be actual cash value, but for additional premium, you have the choice to purchase replacement cost coverage for your roof. And if you're with a company that kind of can go either way, then you would just want to make sure that you're selecting whichever option you want. It's obviously a premium savings to take the actual cash value option. But there again, if you have a roof claim, is it going to be worth that premium savings? And so there again, it just depends on which company you're with, as to how that will go. But it is a good question to ask, just to make sure you're aware of what your loss settlement is.
Right, because by the time you have a claim, it's too late to ask at that point. The coverage is what it is. And to your earlier point, if it's been a while since you've looked at your coverage, it's a good time to reach out to your agent, review your policy, review your coverages. Because again, to the roof claim, material costs have gone up, labor costs have gone up. And so what a roof may have cost $3,000, $4,000, $5,000 a few years ago, I'm seeing they may cost 5, 6, 7,000 or more to replace. So it's important to know what your coverages are. So Eric, other things homeowners should consider in this current environment, it's regards to their homeowner insurance coverage?
Another, I guess, somewhat common adjustment that we've seen over the past few years, and incidentally, the reason that some companies have started going toward actual cash value roof settlement or changing around deductible structures have been to try to somewhat hold the line on premiums a little bit. Kind of like in this inflationary environment we're in, you'll see companies that are either going to raise prices on an existing product, or and you may have seen this, where they start shrinking the amount of product that that comes in the package. They hold the line on price, but then they start giving you less for the same price.
Yeah.
And so that's a little bit there, that when companies are faced with upward pressure, they can say, okay, well, we can raise our premiums, or we can start taking away some coverage a little bit. Let's not do replacement cost on roofs anymore. Let's do actual cash value. And deductibles are another area that sometimes will get changed on people without necessarily them being aware of it. And we'll see this where companies have gone to a percentage-based deductible, or they've gone to a separate wind and hail deductible, which again kind of speaks toward roof claims, which are generally the more common types of losses. But when they're forcing a higher minimum deductible for a wind and hail claim than what the rest of the policy might carry, or they're forcing a percentage deductible. And when you talk about those percentage deductibles, those are percentages based on your dwelling number. So if you have a $250,000 coverage amount for your dwelling, and the company goes to a 1% deductible, they're essentially saying you have a $2,500 deductible. The kind of the problem with that is that as the cost to rebuild your house continues to increase over time, your deductible is being forced higher and higher at each renewal. By the time your home gets to be $300,000, you're now carrying a $3,000 deductible, or so that percentage is always going to be tied to your dwelling amount. So that's something to be cautious of. There are companies out there that continue to just stick with a flat dollar amount deductible, give you what you choose, and leave it there. But if you are with one of those companies with a percentage deductible, it's just good to be aware of how that percentage works and what it's tied to.
Yeah. Yeah. And just to be absolutely clear, that deductible is the amount that's coming out of your pocket, right? As the client, when you file a claim, that's the money that's coming out of your pocket, correct?
Somewhat. The term deductible basically refers to the amount that's deducted from your claim settlement. So generally, you're not writing a check to the insurance company for any amount. It simply means that if you have an $8,000 claim and you're carrying a $1,000 deductible, the company is going to deduct that amount from the settlement check that they give to you. Mm-hmm. So you would receive a $7,000 settlement check for that $8,000 claim. Now, when you go to hire a contractor to do the work, the contractor is likely going to want the full $8,000. So, but that additional financial responsibility that is your portion of that, the deductible portion that comes out of your pocket, that typically is just paid to the contractor who's doing the work.
Okay.
But that's generally with most companies how that is structured.
Okay. So good clarification there. I think the main point for me is to remember, as your deductible amount rises, if you have one of these adjusting deductible percentages, you need to make sure that you have the money available in that event, right? To make sure that you can make up the difference from a financial perspective.
Ideally, yes. When people ask, where should I set my deductible? What should my deductible be? And again, this would be in the case of a flat dollar amount where you're not being, forced into a certain percentage of any sort. But if it's simply the client picking what their deductible is and they say, what should I choose? I typically look at it as the difference between an aggravation and a devastation, because that answer is going to be different for everyone. Somebody picking you know, a $500 deductible for somebody might just be aggravating, or well, let's go higher. A $2,500 deductible for someone might be aggravating. That might be devastating for someone else. They might not have $2,500 in an emergency fund. And so in that particular case, it would be more appropriate for someone who, you know, could come up with $1,000 to have a lower $1,000 deductible, where someone who had a little bit larger cushion or nest egg or emergency fund, who had the risk tolerance to do so, might be more comfortable with a $2,500 deductible. So there's really no right or wrong answer there, is my point. But that's that point at which in your own financial world that an aggravation becomes a devastation, that's usually the sweet spot for the ideal place to set your deductible.
Yeah, yeah. And again, if you have one of these percentage deductibles, we just don't want you to have that creep where you've set it 3, 4, 5 years ago, and you've had this creep where now it's taking you out of that range, where now it feels more devastating should you have a claim.
Sure. And that's where, you know, you can ask if your company has a flat deductible option available, or just be mindful that you want to kind of continue to set additional money aside into your emergency fund each year at renewal, because if the amount of coverage is going up, your deductible is going up too. So you would just want to keep pace with that.
Yeah, yeah, absolutely. Eric, such good information. And I know that these topics are more complex than we can cover in a little 10 to 15 minute interview. But want to make sure that people are aware. I deal with homeowners and buyers all the time. And what I'm hearing consistently right now is look at how much our property has gone up in value. And sometimes they forget these peripheral items and issues like their homeowners insurance. I think it's just a great reminder that even in the midst of home prices rising, which is a good thing for homeowners, that they need to be considering their homeowners insurance as well. If anybody wants to get more information on these topics, Eric, where can they go if they want to talk to you?
Well, I mean, we're online. I mean, you can Google Fox Insurance. We have an office location in New Albany, Indiana. We have an office location in Louisville, Kentucky, Blackiston Mill Road in New Albany, Frankfort Avenue in Louisville. Both phone numbers and office addresses are out there on our website, on the internet. I mean, a quick Google search of Fox Insurance would find all of our local agency information.
Okay, good deal. Well, thank you so much for joining us today, and appreciate your time.
All right. Well, thank you, Mike, for having me. I appreciate it.